Hi, this is Bob Scully, and welcome to another edition of The World Show, Entrepreneurs, the Walter Series. If you've been following entrepreneurs, you may recall Nick Hayek, the immortal, legendary Swiss entrepreneur who passed away a couple of years ago and who gave Switzerland back its economic pride by inventing the Swatch and the smart car. A remarkable set of achievements. But he also had this great voice and conviction and way of expressing himself. And at some point in his interview, he said, "Do not start out in life to make a lot of money. You will not make this money. If you make it, you will lose it. And if you do not lose it, you will not enjoy it." And so, of course, he was not the first to say that, but he had a memorable way of putting it. And I thought of that when meeting Thomas Caldwell, who is such a legendary investor in the world of finance, who became the second largest owner of the New York Stock Exchange at some point. Somebody who's done a lot of things, and yet, as he says, didn't associate with money when he was younger and didn't come from money. And in a sense, that was a blessing in disguise. He only switched career paths because of love. He was pursuing his high school sweetheart. He was going to be an architect, but she went to McGill, and so he followed her there, and that became a career in finance, eventually spectacularly successful. But here is a man who did not follow the money. He followed his heart. Here's Thomas Caldwell. Thomas Caldwell, I hold in my hand a copy of your book, The Success Dictionary, because I felt I could use some. And I went to two words. First, money, of course. And I learned that money cannot buy love.
From the Beatles, of course.
And I'm not surprised. But then I went to entrepreneurs, and here's what I read. They turn possibilities into realities and concepts into jobs and economic progress. Entrepreneurs are the highest rung in the free enterprise system. Now, that's a strong statement, and I get the feeling that you believe in it deeply.
Absolutely. You know, it's one thing to manage and grow a company that already is established, but to create something out of the air, out of an idea, out of a concept, out of a dream, and put everything at risk. Most entrepreneurs are, they have trouble accessing capital, so it's love capital, mortgaging the house. Those are the real risk takers, and many fail along the way. But remember, every major company that we look at started with someone with a dream.
And reading the research on you, including some of the interviews you've given over the years, I came upon a leitmotif, something you come back to a lot, that you weren't born into money and you didn't hang around with money, at least not at first. But at some point, you wandered into bond trading and then you loved it. It was almost like a romantic calling, and you were observing it almost like a novelist would. And that gives me the impression that you went into finance, quote unquote, the right way.
Well, it was kind of backwards. My father was in the meat packing business, and he passed away when I was 12. So I had this compulsion to go into the meat packing business because it was a family business. And mercifully, it was sold. So I didn't know what I wanted to do, but I certainly know what I didn't want to do. And I'd gone into a brokerage firm and saw a trading operation, and I went to McGill University in Montreal and graduated in economics, et cetera, and ended up on the bond trading desk of a very good bond firm in those days. And I moved from there into equities over the years. So absolutely, I loved it. I said to a young person today, do what makes you come alive. And I've been at this a long time now, over 50 years, and I still love going to work every day, and I love what I do, and I generally like the people I do it with. So.
And you've been a co-owner over the years through various vehicles of stock exchanges. That's quite interesting, because it has exposed you to the human geography, so to speak, of some very colorful people.
Well, New York, we were at one point the largest owner of the New York Stock Exchange. We owned 49 seats there. We were surpassed by, I think, UBS with 51. And we were part of the thrust to move it from an old boys club, because we were old and we were boys, into a public ownership environment. So in so doing, I had to spend a lot of time with the specialists on the New York Stock Exchange. And they were great guys and gals, just real Damon Runyon characters. And we had lots of laughs and lots of high stress, and but just really wonderful people. It was a great time.
Do you miss it?
Oh yes. I mean, remember, that was the end of the floor trading era. It's now done electronically by numerous exchanges. New York was still dominant at that point in time. The floor traders had a pretty good go of things. They had a really preferential knowledge base in which to make money. But yes, I do miss it. When I saw recently there was a Starbucks on the floor of the New York Stock Exchange. That's about as close to sacrilege as most of them can imagine.
Because there's nothing more to be done there.
No, very little done there. It's more of a showpiece and backdrop for TV.
And even though there's a trap in nostalgia, there's a parallax. We tend to want to bring back the good parts, but we conveniently forget the bad parts. Nonetheless, in everything you've written, there's a theme that recurs, which is a kind of regret for intelligent trading done with some time built in. That seems to be gone, and you do deplore it. You don't like the speed and scale of the electronics. As a matter of fact, you seem almost frightened of it.
Well, I don't think frightened is the word as much as bemused or whatever. What has happened is the SEC in the United States fractured the market with a thing called national market system. So we have the equivalent of about 64 exchanges versus one or two. So a lot of what we call high frequency trading is taking place just arbitraging between different exchange environments, or picking up a fee in one and not having to pay as much in the other. So there's a whole series of artificial trading influences that are going on here. The flash crash grew right out of that that we experienced some years ago as well. So, and I think a lot of the products that we've developed are cluttering the market. Stocks don't move as much now on the fundamentals of a company or an economy as they used to. There's a lot of extraneous factors, products that are really impacting price of securities.
There's an increasingly widespread reaction among some investors, not the financial sophisticates, but let's say the common sense investors, that the way this is going with product upon product, CDWs and built-in hedges and so on. I don't mean just a straight hedge, a derivative that is meant as a simple hedge, but a whole complex architecture of products that are built on really a kind of mania. There's a feeling that this cannot be good. Meanwhile, the hard-nosed realists will answer back, come on, grow up. This is the way it is, and this is the way it's going to be. Who's right?
Well, it depends whether you win or not. That decides who's right. I always keep saying the only perfect hedge exists in England, and it's cut twice a week. You don't have a hedge, you have two liabilities. So I think you can, okay, I like the company, but the oil price might do so-and-so, so you might short the oil company and buy the oil. There's lots, any hedge you can think of, can imagine, but that does still clutter the price discovery of a security. So you do have that kind of thing occurring within a market environment when you're trying to do hedges or very complex strategy. For example, now, exchange-traded funds, ETFs.
Yes.
That's a basket of securities. And what happens is either they're equal weighted, that is, you own stuff you didn't want to own, or they're market weighted, which some things can be overweighted. So I think people are finding now with the speed and volatility of markets, the ETFs are becoming disconnected from the shares for short periods of time. So you have an old group of traders coming in and try to trade that discrepancy. So what I'm saying is we get a tremendous amount of clutter and unintended consequences every time we have a securities regulation that's changed, or the structure of the capital markets. It's not as simple as it used to be. For me, I tend to look at a longer term when I'm investing. The pools that I run typically are long term. So I trade strategically. What do I think is going to happen with a sector or an economy? And I'll take a view of a 2 to 3 year position, or a 5-year position in some cases. So I'll take a long-term view, build large positions around it, because frankly, I can't keep up with the computers and a lot of the dark pools where orders are hiding. So I keep calling it old guy investing. I can take a longer view. I have the patience, the capital that I have that I work with is with me for quite a period of time. So that's an advantage. I can use the volatility for gains over time.
And do you stay away from these monolithic values built on one commodity or one thing, even though it's very attractive at times? So people will say the gold sector, the oil sector, and skeptics will say that's not a sector, that's just one thing. Gold is one thing and oil is another, and if it crashes, there goes your sector. So do you stay away from that?
I'm a garbage man. I love volatility, and the badder, that's not a word I know, the badder the news, the better, because that means that's where the bargains live. So I will tend to be a bit contrarian, and I'll look at a sector. For example, oils don't look now. So I'll overweight oils for a little bit, because at some point in time, that's going to come back. And if you look at the oil market, basically since the 70s, we've always got it wrong. So we tend
that's true.
Markets, we always overshoot on the upside and we overshoot on the downside. So you have to look at companies or sectors and saying, now, is this thing that's happening, is it transitory, or is it long-term, or is it fatal to a company? And particularly in depressed periods of time, I look for the companies that have money, because they can be opportunistic within that particular sector. So I will look at companies in a down market that have the money to take advantage of this adversity.
I'm going to try out another truism on you. People have been saying for some time that mutual funds, because of the fees they've got, the redemption penalties, all of that, if you compound those hidden costs in there, in fact, you're losing, and therefore no mutual fund is ever worth the trouble. Now, is that too radical?
Well, it is, and I think it's being, you know, I look at suppliers to our business. I never ask, I always say to them, I don't want the lowest price, I don't want the highest price. I want a fair price. Red Adair, you know, John Wayne played him putting out oil well prices.
Oh, the oil well guy.
He had a wonderful line, if there's anything more expensive than hiring a professional, it's hiring an amateur. And being a guy who tries plumbing occasionally, I can assure you that's absolutely true. But I think if you look at some of the successful money managers, Steve Cohen at SAC in New York, now he's had his bundle of troubles. He does not, he pays full commissions and whatever, and he charges a big fee, and he has a lineup with people. I personally don't care what someone else is making, as long as I'm making some money. We manage money for one of the biggest money managers. He headed one of the biggest management funds in the world, his personal finances. And he came to me and he said, I want to pay you a 1% management fee, plus I want to pay you 1% brokerage on top of that, because I want you paying attention to my account. So he knows how this works. You want to get someone's attention. If someone calls me and say, well, you know, I don't want to pay too much in the way of fees, I usually refer them to one of the other brokers in our firm. You know, give them to one of the young guys, because you know, I'm worth what I'm worth.
You send them to the used car garage.
Yeah, okay, good. We have somebody who can handle that, because I don't want to spend time haggling. My job is to come up with ideas, and what I charge is what I think is reasonable, and their end, they're getting the returns that they're expecting. And so I think that's really the key. So I don't care what I'm paying in a mutual fund. That's part of some of the ETF worlds. And remember, in the ETFs, the guys who make the real money are the banks trading the underlyings and borrowing securities. So a lot of money in there for financial institutions. The fee looks small, but the actual paying out is quite a bit. So as far as I'm concerned, I don't care what I'm paying. I don't care if there's a trailer on the mutual fund, as long as I'm getting performance. That my result is what's my end.
I'd be very curious to know, in '08, at the time of Bear Stearns and then of course Lehman Brothers, what were you thinking? I mean, a lot of people were stunned. Most people were stunned. People did not see it coming. But what was your reaction? What were you thinking?
Well, there's an interesting tape done it's almost a year prior. It's called The Last Laugh. It's by two British comedians. And it's humorous, but it was spot on. It had it nailed perfectly. And it was really interesting. Now, having watched that thing, which was terrible, I love British humor anyway, one could have thought it, but most of us didn't understand. See, what happened? You have Barney Frank, et cetera, in Congress saying everyone should own their own home in the United States. So there was a lot of pressure. A friend of mine resigned as a bank director in California because the pressure in making subprime loans put on the banks by Congress. They were actually threatened to audit their taxes.
So it's Congress. It's not the sales force over at that famous company there. I'm looking for the name.
Oh, I know the Italian fellow run it.
Countrywide?
Yeah, Countrywide, Bank of America boss.
It's not them.
Well, the first pressure came to everybody to buy their homes. And so to get this money out, and you had to make a lot of subprime loans. So there was a great deal of governmental pressure to do this. Secondly, in our industry, some of the whiz kids came up with this brilliant ideas. Why don't we take all these garbage loans and put them in a garbage bag, and then we'll get them insured by AIG, and poof, what was trading at 7%, we can now reoffer at 3.5%, doubling our, and that's what Lehman, but the problem is after a period of time, everybody started to believe their own press clippings. Somebody asked me why we didn't have the same problem, say, in Canada. Well, we have rather unique systems. We expect people to have a deposit when they buy a house. Number two, mortgages are recourse. They can chase you for it if you don't pay it. So it was an area that we tended to stay clear of, but no one was smart enough to fully. Well,
there was Paulson.
The Big Short, there were Paulson, the Great Short. But for most of us, mere humans, it was something you didn't want to play in, but you didn't know how it was going to break loose. And you had Greenspan saying, this is taking the risk out of banking. Well, it was out of the individual banks, but it translated into the whole system. Yeah,
it was systemic failure. And I'm wondering, since none of us, I think, had realized the scale of this, were you scared?
No, I mean, what's the old phrase? He who doesn't panic perhaps doesn't realize the gravity of the situation.
Yeah, that's right.
You could see this was serious. This was serious. This was very, very big, and you just didn't know how bad it was going to be. And you could be King Kong as a portfolio manager. When they nail everything, everything goes. Although it turned out to be a very good thing for us because the Canadian banks are getting shorted at the same time, not to the same degree. And there's where the opportunities. I remember talking to brokers in our firm saying, "You will never again in your career see a Canadian bank giving you a 12% dividend yield." And in Canada, you don't cut the dividends on banks. That's a career interrupter if you're a CEO of a bank up here. So it was a different dynamic. So sometimes the beauty of managing money from a Canadian base in the US or in Canada is you can see variance and you can see, America has some wonderful, wonderful attributes, but we can watch when they overshoot on the upside and we can watch when they beat themselves up horribly on the downside. So that provides a distance, not being caught up. I lived in New York for years, so it's sometimes good to be away from that static.
And entrepreneurially now, looking at your business, were your clients calling you in a panic, which would be normal because they were obviously presumably less knowledgeable than you. And what were they asking you?
My job is twofold. To separate what's important from a whole array of over-newsed events. And the second part of my job, the most important, is quelling my emotions and quelling the emotions of those I deal with. For my clients, I would not say there were any panic calls. People are concerned. We had talks about the market, but it wasn't any great panic situation because most of my clients, as you can imagine, I've dealt with for many, many years. And we've piloted through 87, whatever, a lot of market, the 80s, the 67, there's been a lot of messes along the way. Now, a lot of them haven't been there that long. But my job is, most people lose money because of their emotions. That's the number one killer in markets to people.
So in the end, you didn't have to do too much hand-holding, I guess.
Well, it's funny. The best time to have your defenses in place is before the battle begins. And one of the things, when I started our firm, I looked at how firms failed. And one of them was, well, there were several reasons. Number one, proprietary trading the firm's capital. We never did that. We don't do corporate finance. We only have one category of client, the investor. And the third one is no leverage. I don't want margin accounts. So it's one thing to be down 10 or 20%. That's not pleasant. It's another to be wiped out when you're levered up. And over my career, I've had 9 people that I have known, not clients, but brokers, traders at other firms that I've worked with, take their own lives, and it was all leverage in almost every case.
Really? Take their own lives? That's not a small number.
No. Those are ones that knew directly and as friends. There were more, way more.
We associate that with the 1920s, but you're saying more recently so.
Oh, I think there's been a lot more than people realize. And that's just the Canadian number from Toronto. Of 9 traders in different firms I'd worked with over the years.
And looking to the future now, the near future, we tend to think that regulation will come in and finally settle it all, like the sheriff, coming into town and will pay for our sins and so forth. But actually, you're quite bearish on regulation. You think it causes more problems than it solves.
What happens is it takes everybody's eye off the ball, and it's also impacting economic growth. In Canada, we've lost tremendous number of head offices. Inco, Alcan, Falconbridge, Noranda, Dofasco, all these major, they're all gone. Yeah. We're not replacing these companies. Part of it is the cost of raising capital now in the public markets. It makes it unattainable for entrepreneurs. Very difficult to do it. So it's a lot easier, for example, if you set up a company in Kitchener, which is a tech basis in Canada, and you need $10 million for a little idea you've got or a company you've got. Do you go public, or do you not go public, or do you sell it to somebody from Silicon Valley for $100 million and go sailing with your girlfriend? There's a real tough decision. But in the regulatory environment, what is happening in regulations on both sides of the border is it's now into procedure. It's now into process, not in terms of substance. So you're getting regulations for regulation's sake, and you're getting penalties. Now, they're more draconian in the United States because you do like to send people to jail for 100 years, whenever possible. But what we're seeing happen is it's taking time away from the generating ideas, from the client service. The amount of time spent on compliance with regulatory matters.
I know it's become
off the Richter scale.
It's become demented.
Well, it's obliterating the financial service industry, the independent business in Canada. Definitely.
And it seems that one of the other fundamental problems is that regulation and deregulation are wedded to each other, and they're each other's best friend and best enemy, so to speak, because one leads to the other, and there's never a solution. Like, for instance, Glass-Steagall allowing proprietary trading, abolishing Glass-Steagall, that's generally judged to have been a mistake of deregulation.
I agree with that. I agree with that. Glass-Steagall kept America safe for about 70 years after the great market crash. Sandy Weill at Citicorp was one of the great drivers to allow commercial banking and investment banking to be put together. And within 6 years of doing that, the whole system blew up. I always like to use the metaphor, banking should be boring. It's what I call 363. You take in money at 3%, you lend it at 6, and you go home at 3 o'clock. And that's the kind. And insurance should also be boring, but it's not, because once they got rid of Glass-Steagall, they now have depositors' funds for them to play with in the market.
Yeah,
that's wrong.
Yeah, and shouldn't it also be simply more collateral, meaning less leverage? I mean, if you're going to play all these games, shouldn't you be made to have simply more cash in the bank? They'd be making less money in the financial community, but it would be safer. And the new rules, Basel III and Volcker and all that, seem to go in that direction.
Well, I think they are, because there's always these unintended consequences, and I think they're absolutely right. Leverage can be a killer on the upside. You can be on the downside. You think you're smart on the upside, but you do have this double-edged sword. So I think it's absolutely right. Dodd-Frank, which is insane, it has more verbiage in there than the Bible, the Koran, and
they take your fingerprints too, I've heard.
Oh, probably. Well, we needed that for New York Stock Exchange, but so there's a lot of verbiage in there. But I think the Volcker rule. I can't get into the detail of it to say, well, this is wrong and that's right. The basic concept of cutting leverage, as you suggest, is valid.
And there's a very interesting quote from you, what I'm going to read back to you, that you in a piece you wrote about the way regulation and lack of regulation can be both harmful. And I quote, "Regulators have lost focus because they have allowed and indeed encouraged an overly complex financial market to develop. High-frequency trading now counts for a significant portion of all equity trades. You cannot be considered a true investor if your holding period is a fraction of a second. The situation which we have now is one in which the folks with faster computers or better programs are continually able to jump in front of legitimate investors." And that's machines. And nobody has ever stopped machines.
Well, I think it's quite true, but you got to look at the basis. First off, high-frequency traders will tell you they add to liquidity, which they do in a flat market. Market's not going anywhere. They add to liquidity. In a market that's directional, down or up, they take away liquidity because they're trying to hit out ahead of you. They're trying to hit that bid before you can hit the bid. And going back to the old days of a floor environment, say the New York Stock Exchange, if you were a trader and somebody kept running in front of you every time you did a trade, he'd be punched out, or nobody would deal with them. So it's a slightly distance phenomenon. But a lot of the trading that you are seeing, some of this co-location, for example, a company comes out with a new piece of news, the stock moves. Even if I stick an order in, I'm not going to get there fast enough. Or if I put an order in, there's what's called spoofing. People are checking to see whether I'm trying to buy a big chunk of stock. You have this algorithmic trading. It's a very arcane and complex topic. But what happens, even if I put an order in, they can beat me just because of the time frame.
It's mind-boggling.
So there's so much complexity in the market, cluttering what we call price discovery and trading. And I think a lot of it has come out of the rate. If you create 64 exchanges, you see, some exchanges competed on speed. BATS was far faster than New York. But once everybody reached the speed of sound, price became the bargaining point. So you have different fee structures. So you can buy and sell a stock at the same price, taking advantage of different fee structures and still make money on it, or with data, getting data in for rebates as well. So it's overly complex, and this grew straight out of regulation.
And amid all this chaos, Thomas Caldwell, you, of course, seek serenity. You deserve it. And for instance, you're quite proud of being married to the same lady after all these years, dating back to the time when you were chasing her in high school. I think she was 13.
Grade 13,
Grade
actually.
13,
I was chasing her to McGill. I would have been an architect if I wasn't chasing her. But Dorothy and I are still married, of course.
And India. You go to India. I believe you support an orphanage there.
Well, we own part of the Bombay Stock Exchange, and India is really a very interesting place, and in many ways it's even corrupt in many ways still. It's an interesting environment. But when we go into a country, we don't want to go in as carpetbaggers. We want to go in and do something extra. We built a school with the Free the Children, the Kielburgers in Jaipur, a learning center to teach basic literacy. in Bombay, we built an orphanage. We named it after my wife, actually, the Dorothy Caldwell Home. We have 30 little girls there. I love it. These kids are absolutely great. And often I go to meetings at the Bombay Exchange, and I'll say, well, gentlemen, I have a meeting uptown, fairly important. I go and see the kids. They're the most, and
They're more fun.
Oh yeah, and they're really, really smart, and a couple of them are left in garbage dumps. I mean, this is incredible. But an amazing thing happened out of that. My wife was diagnosed with breast cancer a couple of years ago, and it was quite severe, and she had to go through everything. And these little girls, every day before they went to school, would pray for Dorothy Auntie, and that meant so much to my wife, you know. So that was one of those dividends that came out of it. But I love going and seeing them. They're great kids.
Those are the real dividends.
Oh yeah, absolutely.
Well, Thomas Caldwell, good luck and long life to you, and many thanks.
Thank you, and you too.
Thank you. Thomas Caldwell was our guest this week on Entrepreneurs, the Walter series of the World Show. By the way, the exact title of the book is The Success Dictionary, and I guarantee you'll enjoy reading it. I'm Bob Scully. Have a great week. Thanks.